Hello everyone, and welcome back to Explain the Charts, your go-to channel for no-nonsense technical analysis. Today is September 28th, 2025, and we are doing a deep dive into Ethereum or ETHUSD. The market has been incredibly volatile lately, and there's a lot of fear and uncertainty in the air, so we're going to break down both the news and the charts to get a clear picture. First, let's talk about the recent events that have been driving the price action. Over the past week, we've seen a significant market downturn, with Ethereum plunging below the critical $4,000 psychological level. News reports indicate this was part of a larger market slide, fueled by a massive liquidation event that wiped out over $400 million in leveraged long positions across crypto. This classic shakeout was triggered by a reversal in ETF flows, which saw significant outflows for the first time in weeks, alongside macroeconomic fears surrounding a potential U.S. government shutdown. We've also seen Ethereum's funding rates flip negative, which signals dominant bearish sentiment among futures traders, as short sellers are now being paid to hold their positions. However, it's not all bearish news. Some analysts note that key indicators like the Relative Strength Index are flashing potential bottom signals after this sharp decline. Furthermore, long-term optimism remains high, with some major corporate holders suggesting that Wall Street adoption could trigger an Ether supercycle. Now, let's see how these events are reflected on the daily chart. Looking at the daily chart, we can clearly see the dramatic price action of the last 2 months. After a powerful rally from the August lows around $2,400, Ethereum peaked at nearly $4,900 on August 24th. That high around the $4,800 to $4,900 level now stands as our primary long-term resistance. Since that peak, the price has entered a corrective phase, characterized by a series of lower highs and lower lows. The news of liquidations and ETF outflows directly correlates with this sharp sell-off we see here on September 22nd and September 25th, where the price plummeted from around $4,450 to a low of $3,832. This recent low at $3,832 is now the most critical short-term support level to watch. A break below this level would signal a continuation of the downtrend. Notice the volume on these down days. It's significantly higher than the preceding days, indicating strong selling pressure and conviction from the bears. Since hitting that low, the price has seen a modest bounce and is currently hovering just above the $4,000 mark, attempting to find its footing. Now let's switch to the 1-hour chart to get a closer look at this recent price action since the big drop. Here we can see the steep decline on September 25th in much greater detail. Following the low at $3,832, we saw a sharp rebound back above $4,000, but the price has struggled to gain any significant upward momentum since. It appears to be consolidating in a range, roughly between $3,970 on the low end and about $4,050 on the high end. This type of sideways price action after a major drop is very common, as the market digests the move and traders reposition themselves. The key battle right now is for control of the $4,000 level. For the bulls, holding above this psychological number is crucial for building a base for a potential recovery. For the bears, pushing the price back below it would show continued weakness and open the door for a retest of the lows. The immediate resistance on this time frame is the consolidation high around $4,080, followed by the major breakdown area around $4,150. Now, for an even more granular view, let's drill down to the 15-minute chart for the last couple of days. Here we can see the choppy, range-bound nature of the market very clearly. The price is oscillating around the $4,000 level without any clear direction. Short-term traders should be watching for a decisive break of this immediate range. A sustained move above the local resistance cluster around $4,030 to $4,050 on good volume could signal a short-term bullish move. Conversely, a breakdown below the local support at $3,970 would likely lead to a quick test of the $3,900 level and possibly the major low at $3,832. The low volume during this consolidation suggests indecision in the market, which often precedes a larger, more volatile move. It's like a coiled spring, waiting for a catalyst to determine its direction. So, let's go back to the daily chart to put it all together and discuss the potential scenarios going forward. To recap, the key price levels are absolutely critical right now. Our major support levels are the recent low at $3,832, followed by the broader demand zone between $3,500 and $3,600, which was a prior consolidation area. Below that, we would look towards the $3,200 level. On the upside, immediate resistance is at the recent breakdown point around $4,150 to $4,200. A break above that opens the door to the $4,500 resistance zone and, ultimately, a retest of the all-time high near $4,800. Now for our unbiased predictions. The bearish scenario seems more likely in the immediate short term, with about a 60% probability. The trend is currently down, and the failure to mount a strong recovery after such a sharp drop shows underlying weakness. If we break below $3,832, a move to the $3,500 to $3,600 zone is highly probable. This scenario would be reinforced by continued negative news, more ETF outflows, and funding rates staying negative. The bullish scenario, which I'd give a 40% probability, requires the bulls to defend the $3,800 support zone at all costs and reclaim the $4,200 level with conviction. If they can achieve this, it might trigger a short squeeze, given the current negative sentiment. Positive catalysts, like a sudden reversal in ETF flows, would significantly increase the likelihood of this outcome. So, what should you be looking for? Watch the ETF flow data closely and keep an eye on funding rates. Most importantly, watch for a decisive break of the current range between $3,832 and $4,200, as this will likely dictate the direction of the next major trend. That's our analysis for today. This is not financial advice, so please always do your own research. If you found this breakdown helpful, please hit the like button, subscribe to explain the charts, and we'll see you in the next video.